High frequency trading firm impacts the market even if you aren't aware of it. These firms have trading bots that execute trading decisions at speeds that are under the realm of milliseconds and sometimes even nanoseconds. Each millisecond for these firms are worth about $100 million in revenue per year. For example, the infamous flash crash of 2010 cost the market nearly $1 trillion in the matter of a few minutes. How do these firms get trading opportunities and make money at this speed? Let's dive into what HFTs really are and why they are most likely to fail. High frequency trading, in the most simplest of terms, is another form of algorithmic trading. Unlike other forms of algorithmic trading, HFT is completely automated and the human intervention in this is almost next to none. This is mostly because it's almost impossible for humans to trade at the matter of milliseconds. A blink of an eye is 200 milliseconds, and these firms make trading decisions in under 5 or even 1. The strategies that these firms follow to get trading opportunities is completely different compared to what retail traders and firms do on a daily basis. They focus on the market that we cannot see. Most of these strategies are secret and they're not known to the public because of the high competitive environment that these firms are in. The speed and execution of these strategies are so important that it saves the firms almost billions of dollars per year for getting a penny's worth of a better order. That means that if you manage to get a share worth 55.22 instead of 55.23, you're saving $1 billion. There is a controversial debate that has been going on for quite a while. Do HFT traders hurt retail traders? Like all things, there's pros and cons for their existence. HFT firms serve as a market maker for stocks, where these firms provide liquidity on both the buy and sell sides. This ensures that there's always someone in the market to complete the order. Let's say you're a new company in the stock market. If there are not much people trading your stock, then there's a high chance your stock might just crash. So high frequency trading firms actually provide the service to these firms and they make sure that there's always someone in the market trading the stock. Unchecked, however, high frequency trading firms can create the perception that the small investor cannot win. The government has sought to rein in these HFT firms, for example, by proposing per share trading tax. In 2012, Canada raised the fees on market messages, which disproportionately hit HFT firms because they send more messages than any other trader in the market. Despite the fears of high frequency trading, they do not pose a threat as they once did 10 years ago. Revenue and profits have significantly dropped in HFT firms, making it harder for them to survive now. Industry-wide, the annual revenue was estimated to be around 6.8 billion in 2021, which was down significantly from 22 billion in 2011. The HFT program costs a lot of money and brain power to establish and maintain. Not only that, the software and hardware that these companies use need to be upgraded constantly to keep up with other firms. Remember when I said each millisecond is worth $100 million? This means that if you are 5 milliseconds slower than another firm, then that means that you are probably losing a lot of money. But even if you manage to maintain profits by keeping up with these costly upgrades, the underlying program that you use in the market has to constantly adapt and evolve along with it. Programming the evolving market is almost impossible. This means that the success rate for these algorithms is also really low. This is why these HFT firms lose money due to errors in underlying algorithms. The Knight Capital incident of 2012 cost the firm $440 million in 45 minutes. This was due to a faulty algorithm. The glitch caused erratic trading activity and it disrupted the market, causing the firm to lose money. Another reason why these firms are failing is because the space has become really crowded. Individuals and professionals are pitting the smartest algorithms against each other. There are some firms that deploy algorithms to detect other algorithms and outbid them. The net result of these high speed algorithms constantly competing against each other is that the profits become even thinner than they used to be due to the reasons that I just mentioned, along with increased infrastructure and execution costs, new taxes, new regulations. The high frequency trading firms are shrinking. Former HFT firms are even now moving to alternative trading strategies because the environment is getting so cutthroat. If you enjoyed this video, be sure to leave a like and subscribe. I am an aspiring quant trader and I am on the journey of starting my own quantitative trading firm. And I'm here to share my journey and knowledge with you guys. So if you are interested in starting your own firm or even getting a job, leave a comment below and tell me what video you want to see next.